should get that done. There's a second handout that has more of kind of the problem orientation to it. It's basically, there's some stuff in the chapter 6 handout that it goes into a little bit further. And then the chapter 6 multiple choice questions, or that new language I'm working on. And hopefully we get to the sampling. I know I've been saying that for a while. Hopefully we'll get these out. Okay, so less talking. Let's go ahead and jump into here. So I think we're up to the audit plan.
Professor, can you hold on just a second so I can grab that one?
Absolutely.
I don't know if that's the same one.
It should be in the email too, if you really can't find one you were working on.
Oh, okay, you emailed us? Okay.
Yeah, I usually email them. I think I did. Now I'm questioning myself whether I did or not. I think I,
Oh, you did. I got it. Okay.
yeah, and you know, like cut and paste it through.
Let me just download it.
So mine's on page 6. Mine might be messed up because of spacing. I'm not sure, but it should say audit plan. Well, no, actually, I'm going to talk about the other thing. So an audit plan, it's a list of all of this specific of all the things that you're going to be testing. And you know, the one thing that is maybe not apparent when you're taking the CPA exam or being in the classes is that you don't have to recreate an audit plan every single time. In fact, you're better off not to. If it's a recurring audit, which a lot of them are, you'll have the audit plan from last year. And you go through it and you can change it some. You may say, okay, this we don't need to do this anymore, and we have to add this in or whatever. But those lists of procedures and stuff, you know, you don't have to memorize all those and have them in your head. You know, so when you audit cash, you don't have to have the 27 ways that we audit cash. You don't have to have that in your head. It will be in the audit plan. And what they do is at the beginning of an audit, the supervisor, probably working with the manager or whoever else, will split up. Okay, you're going to take inventory. You're going to take accounts receivable and payables or whatever. You know, you split up the different sections, and literally you'll get handed the section that has what you're supposed to be doing, and you follow it. Now, if there is something written down, some kind of testing that's written down, remember everything is made by humans, whether it's computerized or not. If you don't understand it, it's kind of up to you to make sure that you can either figure it out or ask your supervisor about it. Don't ask them about everything, but if you really, and there have been times when I looked at it and one of the things is that people's writing skills and all that kind of stuff is all different, and people have different ways of writing, and it's all communicated with writing. Another weird thing about auditing is how much is writing, but it lists all the steps that you're supposed to do. Now, each one of those steps might be a whole spreadsheet full of testing, but so you don't have to memorize everything. And so we're talking about this audit plan. That's what we're talking about. And the plan is originally you sit down and you figure out what you're going to be doing, what you think you need to cover, and all that kind of stuff. Invariably, that changes. It just does. Some stuff comes up. Something you thought was really important that doesn't even exist anymore, maybe. There's all kinds of things that happen during an audit that you do have to change it. So it isn't like it's set in stone. Like, oh, we got to follow the audit program no matter what. If things change, you do change the audit program. And you're always trying to be effective, but also efficient, when you're doing your auditing. Okay. No, let's see what I was. Okay, so audit plan. Yeah, this is on page 6 for me. I don't know if it's 6 for everybody or not. Okay, it's very detailed. It's not general in nature. It's very detailed what you're going to be doing. And again, it's usually based on previous audits, either at the same location or possibly even other audits that have done in different places. And we have Google now. You can actually Google and find audit, programs for cash and all that kind of stuff. Okay. So we have assessment procedures. And assessment procedures are to see where the risks are. So we're really looking for what could go wrong. Now, once you figure out what could go wrong, right? This is what could go wrong. Down here for B, you say, okay, well, what do we do? You know, what audit procedures, what do we actually do to see if these things went wrong? So if it's if you're auditing revenue and you say, okay, these are the 5 things that could go wrong in revenue, how do we audit those? And those are the procedures that you come up with. So you basically, the first step is see what could go wrong, and you're kind of brainstorming here. You might look at what happened in the past, but also, you know, thinking, okay, well, if I was going to do a fraud, how would I do it? I can't tell you how many times, you know, I sat around with people or just by myself thinking, that person, how would I do it? Okay, and other audit procedures in order to comply with auditing standards, which we'll talk about later. Okay, and again, this is a tentative plan. It is not set in stone. If something happens, you react to it. Okay, so the audit plan has which of the following characteristics? Is it general in nature? Nope. Detailed, yes. So this is it's a detailed list. Cannot be changed once the audit is started. We just talked about it. No. Is based on risk, yes. It is the same for all clients. No, I'll talk about that in a second. Maybe change for revised risk assessment. This is true. So the answers to the first one here are B, D, F. B, D, F. Those are all parts of it. The other 3 are not. Okay, is it the same for all clients? Not only is it not the same for all clients, it's not the same from one client from one year to the next. So, yeah, one time we had Chinese food at our house and we had fortune cookies. And my favorite fortune ever from fortune cookie was, there's no such thing as an ordinary cat. You know, cats are all different colors, sizes, hair. There isn't, you can't just say here's an ordinary cat. And it's the same way with businesses. There is no ordinary cat. There is no ordinary business. You know, Walmart and Target are in the same, you know, retail environment, but they're very different. You know, everything about them, their management is different, their inventory is different, their how they range, you know, it's all different. You can't take one and go to the other. So now, and again, from one year to the next, it can be very different. I think I told you that some of these entertainment companies, streaming is a big thing now, but a couple of years ago they were talking about how streaming was going to be everything. Everything was going to be streamed. Well, they found out they're really not like that. So here you have this ramping up of, you know, auditing based on the streaming content that you think is going to happen, and now you have a new thing thrown into it that this is not as lucrative, or the projections are not what they thought they were going to be, and it's a real different market now. So even from one year to the next in the same company, you probably won't have the same audit. Okay. Understanding the client and its business environment. Okay, so we have to figure out how the client works, but also the business environment. And this is one of those things that kind of sounds weak, but you'd be surprised at how much information you get, and that is inquiries. Just asking people. Good auditors ask lots of questions. Yeah, and you sit there and let them explain it. Don't lead them on or anything like that. But so inquiries of management, just ask questions and let them go. Observations. And inspections. Observation is a huge one. This is probably some of your best. Oh, by the way, I skipped over analytical procedures. We're going to do analytical procedures below here. But observation is a really good one. It's the most persuasive. So observation is the most persuasive type because it's personal. It's you know what you saw, and a lot of times people will tell you a number of different things. Sometimes they'll just outright lie to you. Sometimes they will tell you what they think it is. Okay. And sometimes they'll tell you what they think you want to hear. So you have these, when you ask somebody else a question, when you make inquiries, a lot of times what you get back is not exactly right. So if you ask a manager, okay, how do you, what do you do with for credit memos? How do you handle those? That manager may tell you, may lie to you, maybe they don't have any procedures, may tell you what he thinks or he or she thinks it is, or he or she may tell you what they think you want to hear. They want you to walk away and leave them alone. So, so you can get all these different things. Now, when you observe how they actually do it, that's firsthand knowledge of how they actually do it. And a lot of times you'll be standing there, it's a hard thing to do, but sometimes you just be standing there looking like you're halfway interested, you don't want to sit there and glare at somebody, watching every move they make. They may they may do something crazy or something, but you just just talk to people and look around the room, ask about different things, and don't keep hammering them, but just watch how they do things. And it is an art to do that. Okay. You might talk to people outside of the company. So lawyers are a big one. Talk to their legal counsel. Sometimes valuation expert. It really depends on what you're looking at. There are some things that are harder to value than others. And reviewing information from external sources. Analysts, banks, rating organizations, business publications, all these things are external that talk about the company. And a lot of times, one of the reasons why you may focus on those external sources, sources, you may say, well, who cares about those, right? I mean, they're not inside the company. You're inside the company looking at their financial statements. Why look at those? Those are part of what might be perceived pressure. So maybe an analyst said that this company's, the research and development isn't up to what others were. Well, that might make a change in how they present their financial statements to make it look like they're, it could be a perceived pressure for them to, that might influence how they present the financial statements. So sometimes the external forces are, even though they really don't have much to do with directly with a company, they may have an influence on the company because of who they are. Okay. Analytical procedures. I think we'll do an example of one, and then we'll talk about what they actually can do for us and what they can't do for us. Okay, analytical procedures. We analyze relationships between data, financial and non-financial. So that's kind of what it is. We generally look at ratios. So ratios are a real big thing for analytical procedures. And this is one thing that all analytical procedures generally have in common, is that they're looking for what they call plausible relationships. I'll show you what I mean in a second. Let's take a look at this example. So here's a 2022 sales, 22 million. The advertising expense is 610. Two 2021. Sales are 19.8 million, well, it was 20 million. And the advertising expense is 825,000. So what is unusual about this relationship?
Is it the advertising expense was less in 2022 than the prior year?
Yeah. So what's unusual is that sales, oops, that's not how you spell sales. Sales increase. But advertising decrease. Now, usually the plausible relationship, you'd think, okay, well, if sales increase, it's plausible that advertising would increase too. You know, how do you make more sales? You do more advertising, or you pay more commissions if it's just, you know, you're paying commissions to people. So how does this work that, you know, sales increase and advertising decrease? Okay, so given this, you go, okay, well, what do you do with it? You know, what does this maybe indicate? So what might be the risk that this would, that you might have to investigate?
That spent less on advertising and pocketed the money or something like that.
Okay, so they spent less on advertising. So maybe the advertising expense might be too low. I'm gonna use the auditing lingo and be understated. What else might be the problem? So it could be that the advertising expense is understated. There's one other thing it might be.
Could it just be an error?
Could definitely be an error. And you know, if it's a advertising expense, you know, could be an error. But there is one other. What's the other account involved here?
The sales?
Yeah. So maybe the advertising is fine, but the sales are not. And it's possible that these are fictitious sales. So another possibility is that, oh, maybe, oh, all right, okay, I get it. On usage. So it could be that sales are overstated. In other words, this 22 is too high. That's a possibility. You know, maybe the sales really should be 16 million or something like that. So this might be an indication. Now, and it could be, uh-oh. It says my internet connection's unstable. Can you guys hear me okay?
Yeah, but you were just frozen, but now we can hear you.
Oh, okay. Now I admit it, were you guys happy when I was frozen? You probably were. All right, so, so it could be advertising expense is understated, it could be sales are overstated, and either one of those, it may be fraud or maybe a mistake if they are. I mean, it doesn't necessarily have to be fraud. It could be an error, you know, but it could be either one, error or fraud. And I'll put that in here. Oops, oops. Error writing error. So yeah, it's not always about fraud. I mean, it could definitely be, and there have been financial statements, big companies that put out financial statements of theirs in them. General Motors had a huge one like 10 years ago. It was caught by a graduate class. But anyway, so it could be error or fraud, you know, either one were the same overstated. Now, you'll notice something else about this though. Is this absolute evidence that these are misstated? You know, are you going to go in there and tell them, look, these are your sales and your all these are completely misstated? Is this direct evidence that they are misstated?
I would not think so.
You're right. They're not. It's not. It could. These could be absolutely accurate. You know, it could be that hey, they just you know, they made more sales, they tweaked some things, and they're advertising less and it's getting more sales out of it. It could be they're just doing better. So you say, okay, well, why do we do this? Well, here's the thing about analytical procedures. Analytical procedures merely direct the auditor to possible problems. They are not generally evidence themselves that anything has gone wrong. These could be absolutely accurate. There's, you know, and until you look into it, you won't know. So we use analytical procedures to look at where the problems might be. Not because the analytical procedures will tell us directly that they're fraud, but it will tell us where to look. Now, analytical procedures are required. If you're doing an audit, they are required. It's not optional. You have to do analytical procedures. And you say, well, why? You know, they might tell you to look at something that isn't a problem. Well, because analytical procedures, they find something like 95% of financial statement fraud. It's huge that they point in a direction, because there is something about the financial statements you got to remember is this is going way back to your accounting, you know, 210 or whatever, your intro to accounting. It's a double entry system. There has to be a debit and a credit. Two things have to happen. So if you increase sales, if you say, okay, we need more sales, we'll increase sales. There has to be a second half to it, or else it's not going to balance. Because of that, things can get messed up on your financial statements when you decide to I think I just raised a hand for some reason. Mr. Taylor wants to talk. But anyway, it's you know, the double entry system means that if sales go up, something else has to go up or down, you know, and so there's always this trade-off of what it is. So you can't just increase one thing and then have it work out that, you know, oh, nothing else changes in the financial statements. They'll never catch this. So you're always looking for relationships, and analytical procedures looking for plausible relationships. It's possible that there's a relationship that's not normally what you look at, that's implausible, but it, you know, it is possible that it worked out that way. Again, it could be they decreased advertising, or, you know, we're more efficient in their advertising, or whatever it is, and the advertising expense did go down. Okay. Now, when it comes to risks, so we're looking at. We use analytical procedures probably to look for the risks involved, and we go, okay, when we come to a risk, there's always two parts to a risk. There's a dollar amount. And there's a probability. So whenever it comes to a risk, we're looking at two things, a dollar amount and a probability. So example A, B, and C. So we have these three risks. Which is the greatest concern for auditors? Well, one thing you have to do is multiply them out. And so the expected risk, 1% of 5 million is 50,000, I think. You may want to check my math on that. Risk B, 400,000 times 40% is 60. And risk C is 80% times 5,000, which I think is 4,000. So which one is probably the greatest concern?
B has the highest probability, but yeah.
Yeah, probably risk B. And let's talk about these other ones and see about them. Let's look at risk A. Risk A, the dollar amount is by far the biggest. Why is that one probably not that big of a deal?
Because the probability is just a 1% of that.
Exactly. It's very unlikely this is going to happen. You know, it could happen, yeah, but it's very unlikely. You know, where 40% that's a pretty good chance it's going to happen. Okay, well, what about C? Why, you know, C has an 80% probability. Why isn't that one?
Dollar amount is less than A and B.
Yeah, it's a very small, relatively small anyways, amount to these other two. Even though it's likely it's going to happen, it's probably not, you know, it may not even be material. You know, that even if it does happen, probably it may not make any difference. So when you're doing risk analysis, there's always this risk, this idea that there is a dollar amount, you know, and then there's the probability of each one of those. That is not just, you know, looking up here saying, oh, the dollar amounts, oh, they might lose 5 million this way or whatever, or, you know, be at risk. So you're always looking at the probability of it also. Okay. A question that is very common of everyone who does auditing, and not just students, but people actually working in it, is what is material? And what is material is a judgment call. So, and I know that, you know, this kind of seems like with all the computers we have and all this stuff, you know, you think that this wouldn't be so much of a judgment, but it is. Everything in auditing really is a judgment call. And materiality is no different. Okay, A is the quantitative considerations of materiality. And so quantitative considerations are dollar amounts. And this is what we usually think of. So a dollar amount, so maybe it's $60,000, maybe $60 million for a different company and whatever. So quantitative are the dollar amounts. How many dollars would it take for this to be misstated before you get worried about it? So my spacing there. Okay. And again, this, this amount, we'll find if there's some rules of thumb we'll do later on to come up with this. But there is another side of these, and that is, there are things beyond simply the dollars that make something material. So even if the dollar amount is not material, if you do find a misstatement, it's possible that even though the dollar amount isn't enough, that it might be material because it does one of these things here. There's actually more than this, but if it violates a contract, a loan agreement, or a government contract. I don't know why they have those in there twice, because the contract's a contract, but so if it violates a contract or a loan agreement. I'll give you one that it's very common especially for mid-sized companies, when they do banking, the bank that they work with will say, look, we'll do the banking, but you have to you have to get all your money from us. All your banking has to be done through us. If there's a loan, it has to come through us. That's just the way they protect themselves against you running up a bunch of loans all over the place, going bankrupt, and then they're left holding, nothing. So a lot of times they'll have that. Well, you may have a client, somebody you're doing their audit, and maybe they have one of these one of these bank agreements, but they got a loan from somebody else. It violates the loan agreement. So, it might be immaterial. Maybe it's $5,000 and the materiality is $60,000. Okay, but that $5,000 loan is in violation of that contract, is that violation of that loan agreement. Because of that, it becomes material. So if there's a violation, because you gotta remember, whoever picks up those financial statements, they are going to believe what's on there. And they'll probably be using it to see if they're in compliance with their contract. The users of the financial statements, you always have to keep in mind them. And to them, getting any money from a different source is a violation of their contract, the contract they have with them. So, but violation of contracts is a big one that you look for, that even though it might be immaterial, if it violates a contract, it could become material. Reverses a trend. These two are kind of the same. But reverses a trend may be that you go from having losses to income, or you go from sales declining to sales increasing. So, they'll say the dollar amount is 60,000, and they say, oh, you know what? if we just add 20,000 onto our sales will look like they went up from one year to the next. And sales increasing, from one year to the next is a big deal. So if it reverses the trend, it might, even though the dollar amount might be immaterial, maybe it's 20,000, it might be material because it reverses the trend. And this one, change a loss to a gain. So they're gonna have a little bit of a loss, instead they tweak the numbers and have a little bit of a gain. It's not material, but changing a loss into a gain is a problem. Okay, this is probably the scariest one of all of them. Management fraud or concealing a fraud. It matters who is doing it. For instance, if you have a lower level employee figures out that they can steal stuff off the loading dock and no one will find it. And they're doing this routinely. They got a system down of doing this. And they steal, $40,000 worth of stuff. Okay, that's a concern, obviously, but if that's all it is, it's not material. However, take that same thing and it's an operations manager that's doing it. So the operations manager is stealing from the company and it's $40,000, same amount, but it's the operations manager. Notice the operations manager is a very important person. So if they're doing something wrong, it leads you to believe, okay, there might be a lot more of this going on. They're in a position of power. Also, the integrity of management, which is the key thing, is the integrity of management goes out the window when you find out that someone in management is actually doing a fraud. Because now, one of the things about frauds are that, they, there's concealment and all those things that you don't like. They go with it and they must be doing it. So if upper management is involved, especially, it's a big problem if there's a fraud, even if it is quantitatively, dollar amount is not enough. So for instance, I think I told you guys that, like for Walmart, you find a $5 million fraud. Probably just completely ignore it, unless it's somebody in upper management. If it's somebody in upper management, all of a sudden now you can't trust management. The integrity of management is coming to question now because of who it is rather than the dollar amounts. So even though $5 million, obviously not material to Walmart, it is material depending on who did it. Okay. Things that increase management compensation. So, maybe hitting a sales number or a cash number or something like that means that they get a bonus. And so they cook the books to enough to get that bonus. Now, maybe it's not the dollar amount isn't material, but if it's for management compensation, if it kicks in for management compensation, it could very well be that even though it's less than the dollar amount, that it is material. And a misstatement due to fact rather than an estimate. And what they mean by that is that we don't have crystal ball when we do accounting. So if we're, this scissors, okay, it's going to last for 5 years and we depreciate over 5 years. Actually, we didn't do that for scissors, but let's say it's a really nice scissors. So we're going to last for 5 years and we're going to depreciate over 5 years. Now, we don't have a crystal ball. We don't know exactly how long this is going to last. That's an estimate, right? And the problem with estimates is that, just what they are, they're estimates, they're not actual numbers. So the fact that we said that this was gonna last for 5 years and instead it lasted for 3. Well, that might be somewhat of a problem. It's not nearly as much as if you say, okay, this scissors cost $60 instead of 6. You know, that's a misstatement due to fact, not an estimate. So misstatements that are due to fact are considered more serious than simply one that's due to estimates. So even though it might not be material, the fact that they are purposely misstating it, misstating a fact, is could be also be a problem. Okay. Well, here are some of the materiality benchmarks, rules of thumb that we will use for quantitative. So this is for dollar amounts. You know, so you say, well, what is material? How much is material, you know, for this? Okay, so here are different ways of doing it. There's a whole bunch of ways of doing this, but oops, it's kind of silly me. So, and you can use a combination of them to get a range too. So let's say you have 1, 2, 3, 4 ways of doing it. You know, again, there could be dozens of ways of doing it. Oh, look, I grouped up my spacing. Okay. What do I have here? Oh, I see. These are percentages. So 5% is 0.05. Yeah. I figured out what I did here. So you know, 5 to 10%, 0.05 to 0.10 and a decimal. Okay, so these are some materiality benchmarks that you can use, and it really depends on the company which ones you're going to use. Okay, so income before income taxes is one of them. Total assets, total revenues, total equity, and again, these are all judgments. You know, they're now, even though you pick one method and say, okay, it's, you know, we're going to use this first one here, you know, okay, you know, we're going to use this one. Well, that's a judgment call. And actually, we are going to use this one. So, as one of the benchmarks, we could use any one of these, but we're going to use income before taxes. We're going to come down here to these 3 companies and see which, you know, see how much of what's going to be their materiality. Now, you'll notice something. Income before income taxes, the 5 to 10%. That's a pretty big range, actually. You know, 10% is twice as much as 5%. So the question is, which one do you use, or do you use something in between? And here's how this kind of works out. The larger companies will get the smaller percentage. So this will be the larger companies. And the smaller companies will get the higher percentage. I'll tell you why in a second. So a large company will get the smaller percentage. The larger percentage will be for the smaller companies. So if it's a large company, our materiality will be 5%. It's a small company, we'll let it go to 10%. Okay, and you might be wondering, why is that? Well, because small companies usually are, you're talking about smaller dollars. So you let the higher percentage go because the actual dollar amounts, if 10% means that they're off by $5,000. No one's gonna sue you for $5,000. A lawsuit will cost more than $5,000. So, the materiality, okay, well, we'll give them a little bit more leeway. We'll go like say 10%. Rather than 5%. There's no reason to hold them down to this smaller one. Larger companies, when you start talking about hundreds of millions and billions of dollars, even a small percentage is a lot. 1% of $1 billion is a lot. And you don't want to have to go into court and say, we missed a $230 million error because or fraud because it wasn't material. People will sue you for $230 million. You can guarantee that there can be a lawsuit flying for that one. So again, we hold the larger companies, we hold them to a smaller percentage because the dollar amounts are just astronomical. In a lot of cases. Okay. So let's go to company A. They have income of 150,000. I am going to copy this down here so it's a little closer. Okay, so I'm gonna get rid of this one. Okay, so here we have, so company A, is this a large company or a smaller company?
Here smaller. I mean,
Yeah.
that's their income before tax.
Yep. Yeah, so this is $100,000. We're gonna multiply it. We're gonna use the 5% or the 10%.
10%.
Yeah, probably 10. What is it, 15,000? So this would be the materiality amount that we would have for a small company. This would be what we would calculate as a materiality. Okay, let's space this a little better. Let's go down to the next one that's maybe a little more obvious, and that is this large company. 1,500,000,000 in income, so $1.5 billion in income. What percentage are we probably going to use for this one?
5.
Yeah, this is one of the, it has to be one of the bigger companies in the world, so we're going to keep them to a little bit tighter rein as far as percentage wise, but it's still going to be a large dollar because that's just how. I'm going to cheat and use my calculator. I should be able to do that in my head, but
You are missing 3 zeros.
yeah. So this would be 750. I'll be doing it. That'll be 75 million, right? I'm trying again. Yeah, 75 million. Oops, wait a minute. Yeah, no, that's right. I get what you're saying. Now I understand. You're right. I was missing those. That's why I kept looking funny. And, you guys got those 75 million?
Yes.
All right, so. Again, no one's probably gonna sue you for 15,000. Now they might, but not as likely, but 75 million people sue you for that. So that's why we keep these larger amounts, we keep them to a tighter. Range. Okay, now. Company B. A $50 million company, they have $50 million of income coming in. Now, they're not the largest company on the planet, but they're also not the smallest. So now we got to come to some judgment call. We're probably going to use some number in between 5 and 10%. So you want to throw out a percentage between 5 and 10?
7.
Okay, good. Oh, wait, I did that wrong. Okay, so again, they're not the biggest company, but they're pretty good size. They got 50 million, that's not bad. And we're gonna multiply that by, you said 7.07,
3.5.
3.5 million.
Yep, 3.5. Yep.
Oops. Hold on. Okay, so for this company, we will say, okay, that $3.5 million will be material. So again, this is what they call these rules of thumb, and we could use total assets or total revenue. There's a bunch of different ones we could have used, but taking this one, and if you're wondering how to apply it, though, the larger they are, the smaller the percentage we allow them, and just the opposite for smaller. The smaller they are, the larger percentage we allow them. And something that's in between gets, a number in between here. So, yeah, there is judgment involved in this. Judgment which one you use. For example, well, I'll give you an example of when this would not be a good one to use. Income before income taxes. It's a very common number that a lot of times analysts look at, but it's possible that it's not a good one. And the example would be, suppose they have a loss, or they have very little income. Maybe their income is really small, and because they get a materiality that's really small, and it did. For the size of company, it shouldn't be that small. Maybe it's if they have a small income, they have a bad year or whatever. And that way you go, okay, well, let's look at the assets instead, or something else that's a little bit more stable, or total sales maybe rather than income. The sales, even though the income might be really low, the sales might be a good way to figure out what the is. So it really depends on the company, what kind of position they're in, and it is a judgment call. So which one of these, even when you use these benchmarks, which ones you should use. Okay. We'll do performance materiality, and then we'll take a break.
Oh, Professor, I have a follow-up question for the materiality of benchmark. So I know you mentioned larger companies get the smaller percentages. Is that on all 4 of those, or that's just on the income tax before income tax, or income before income tax?
It's usually on all
That's
of them.
on all of them.
Yeah. No,
Okay.
equity. I think I copied this out of the book. I think total equity is a there usually is a range of them. This one.
Oh, okay.
But yeah, they usually do have a range to them, and sometimes the range is pretty significant. I've seen rules of thumb that were 0.5% up to 10%. That if you're Walmart, you're going to get the 0.5%. Because 0.5% of billions is a lot of money. Whereas, it could be up to 10% that if you're coming to make 100,000 a year, it's not going to be that big of money. So it really there can be a very large difference in there. And different companies and different audit firms will have their way of determining materiality. There is no one right way to do it, and it's a judgment call. No matter how much you try to quantify it, it's a judgment call. Trying to figure out what would make a difference to somebody. Okay. One of the things that they will often do is they'll find an overall materiality, like we did on the previous page. You know, this is an overall materiality. Right, 3.5 million or something, whatever it is. And we will allocate it to the different accounts. So it isn't just that we let any account be off by 200,000 usually. This is the overall materiality. So we can, a lot of times they'll do a what they call performance materiality. Oops, my arrow's backwards. Go switch around. And so what we're gonna learn how to do is use a computer. After I do that, so we're gonna take this overall materiality and divvy it up somehow between cash, accounts receivable, and inventory. Now, depending on the size of the company, a lot of times cash, you can look at 100% of cash. But you say, okay, if it's off by a little bit, how much are we going to make a big deal out of it? Well, cash maybe being a little important, you want to keep tighter reins on it. And you might say, okay, $10,000 for cash. I'm just making these up. So we're going to let the cash account of that 200,000, 10,000 is going to go towards the cash account. How much is going to go towards the accounts receivable? Just make up a number. But it has to be, between 0 and 190,000. We're trying to split up this 200,000, and I just arbitrarily put 10,000 to cash.
80,000.
Okay, good. 80,000. And what would that mean for inventory? What would inventory be?
Is it the balance of that, or can it just be any 110,000?
Yep. Yeah, so 110,000. Oops, let's put one more zero there. Pretty much. So this would take, and the term for this, I'm not exactly sure how they came up with this name, but it came out of like 3 or 4 years ago. But they call this performance materiality, probably because when you're performing the audit, so whoever gets the cash section, they'll tell them, okay, materiality is $10,000. And whoever gets the accounts receivable section, they say, okay, materiality is 80,000. And whoever gets inventory, it'll be 110,000. So performance materiality is basically splitting up the overall materiality. There. And it's just so that people who are doing these different sections of the audit will know what to look for. If you're doing cash, you're not looking for a $200,000 error, you're looking for a $10,000. Okay. All right, well, let's stop here. There's a lot in this chip. What is it, 659? 709. Just gonna take a quick peek here. Okay. All right. Oops. There we go. Sorry about that. I think I told you guys this already, but I was talking about materiality. And I work for Navistar. Navistar sells Navistar sells trucks. And they also own an insurance company for trucks that they, so that if people buy the trucks have a hard time getting insurance, they can go through us and get it. And it was actually fairly profitable for us. But it was a insurance company. I was helping the external auditors, and I found a $100,000 error in cash. And so, all excited, hey, okay, and I show them all the calculations. I remember the senior auditor. So I'm the internal auditor, just working with them, just doing some of the testing, and then they'll make the judgment calls. And I remember the CPA firm, the senior, just kind of looked at me like, so what? So, anyway, it just kind of shows you the materiality that as an internal auditor, $100,000 is a big deal. External auditors, it wasn't. I did show it to the director of internal auditing though, and he was a little more interested in it. But okay, there's a whole bunch of things here for types of evidence, kind of a laundry list, which is one of those things you almost think is ridiculous to put out, but not that getting evidence this way is not important, but again, you see a big laundry list like this, and it's really difficult to for it to mean much. But I'm going to go through a few of these and just kind of go through which ones are usually the ones that are a little bit better. Inspection of record and documents, that's what people think about when they think about kind of auditing, but there is a lot of other things that we do. All right, what am I doing wrong here?
It's PER.
Oh, thank you. My wife was an English professor. Now she's a therapist, but she was an English professor. So, and my kids are all really good at spelling, so I get spelled that a lot. Anyway, so observation is anything that you do by yourself, on your own, is actually more than, say, asking other people about it. So observation is a good one. Recalculation is a good one. Reperformance is a good one. So those are all very persuasive ways of getting evidence. Confirmations, a lot of times, are with third parties. So per third parties, so what we're talking about here is like things like accounts receivable is a big one for confirmations. So they say that, okay, we have all these customers that owe us money. Well, you pick some of those customers and you will confirm those amounts. So, for instance, let's say it's making a number up. So if you have a customer that owes them $5,430, you can send them a letter saying, do you owe $5,430 as of December 31st? So you can actually do a confirmation of those accounts. That's also a good way because a third party is generally considered to be an unbiased source of information. Okay, you can look through these, and a lot of times it's Well, all of these are good, you know, having a big laundry list like this is a little bit much. Okay. Now for the really kind of somewhat boring part of it. I should say it's just boring because of how much of it there is. Assertions. Assertions are either explicit or implicit in the financial statements. Okay. And here's a bunch of them, the big list of all of them. But I'm just going to pick out a couple of them that we're going to talk about more later. Completeness and existence are two of the really big ones. So completeness and existence. Completeness means, is everything there? And existence is occurrence can also be in there too. So for instance, completeness, let's take inventory. Do they count all the inventory? So you may test to see if they counted all the inventory they're supposed to. You know, is it complete? Did you get all the inventory you were supposed to get? You may also look at the existence of it. So if they have inventory on their books, you can say, okay, well, let's see if that inventory actually exists, because it might be just fictitious inventory they're putting on there to balance out a fraud or something, or to overstate their inventory. So, you know, completeness and existence are two of probably the biggest ones that you'll do in testing of the financial statements. And given that most of our auditing is focused on the balance sheet, assets are usually those focus on. So existence and completeness are big, because we don't know if there are assets that are actually there, that they say they are, or are there assets there that they aren't counting on their books. So you can go either way on. Okay. And actually, the second handout we have for this one. So a little bit of a difference between the AICPA assertions and the PCAOB assertions. Not too much. There's a lot of overlap between them. You'll notice that a lot of these same ones show up here and down here. But yeah, so they both have their own, but they're often kind of overlapping. Okay, and so here's just an idea of, say, a substantive audit plan for assets. So let's take an inventory, for example. Does the inventory exist? They have inventory on their books, does it exist? Do they have the rights to the inventory? Even though it exists, it might be that they don't own it. Maybe it's somebody else's inventory that is you know, in their possession, but they don't actually own it. Or it could be that the inventory is pledged for a loan, say it's pledged as collateral that they can't sell unless they talk to the bank, and the bank will allow them to sell it. So there's all kinds of things about the rights of inventory. You know, something that's, for instance, that they're holding on consignment, they don't actually own it, but it is sitting there. Or something that's pledged for collateral for the bank or something like that. Completeness. Most of our testing goes for these two, quite honestly, a big chunk of it. Cutoff. Cutoff and valuation used to be the same, but cutoff is cutting off the transactions at year end. Getting all the transactions in the right period. Valuation. Especially things like long-term assets, depreciation, all that kind of stuff. And also presentation is the disclosure, how they're showing on the financial statements and in the footnotes. Okay. All of these generally apply to specific accounts. There is auditing now that is, they basically want you to look at what they call the cycles. And these are the cycles that the AICPA has listed. Now, there's nothing wrong with the cycles, but quite honestly, the testing is going to be exactly the same. For example, cash, you know, if you're doing a revenue cycle, part of that revenue cycle is going to be cash sales. You do the same time testing that you do for the cash account when you're doing the cash sales. Doing you know, the acquisition of inventory and paying and accounts payable and all that kind of stuff, those will come out of cash too. So accounts payable will be paid out of cash. So the same testing that you do if you're just auditing the cash account, seeing how the payments are made out of it, is the same test you would do if you're, you know, part of your cycle was the accounts payable stuff. So yeah, it's but they talk about the cycles themselves. Okay, I think this is near the end of it. Okay, good. Audit plan. Who owns the audit documentation? I think we talked about this. Did we talk about who owns the audit papers, work papers?
I can't recall, we did.
Okay, the CPA firm owns them. So the CPA firm owns the audit documentation. And while it is, you know, it shows evidence for a few different things. Is evidence that you planned and performed and supervised the audit. It's also going to be the support you have for your opinion for the audit report, which will have your opinion. So that if you go into court, you can pull out your audit work papers and say, no, we audited that. You know, we may not have come to a correct conclusion, but we did our job. We did what we, you know, thought we were supposed to do. So it's support for your audit opinion. And third, working paper review, and this could be from I think how to write this. Well, it could be from the AICPA, they have reviews. It could be from the PCAOB. And it could also be internal. For the CPA firm. Oops. That should not be a. So working paper review, AICPA, it's possible they have a peer review. PCAOB, they will do examinations. And internal for the CPA firm, they will also be doing. And I may as well say that this review of the working papers, AICPA, the review can be after the report is issued. Should be a D. PCAOB, the review must be done before it is issued. So a little bit different timing on those. So it can be done after the AICPA. It must be done before for the PCAOB. So PCAOB, it has to be reviewed before they issue the audit report. Permanent files are those things you'll keep from year to year. You can look over these, there's nothing too crazy, but a lot of these things are just things that you will keep from year to year, and you'll probably update these. For instance, like this organizational chart, you know, someone may have come in, you'll simply update it from year to year. But the organizational chart itself will be in your permanent records. Document all this stuff. The current file has said it's only useful in the current year. So financial statements, you're only gonna, you know, they're only gonna issue the 2022 financial statements once. So, you know, those kinds of things are things that are for just a single year will be down here. I think that's it. Okay, the next thing I want to do, and I always try to improve this thing, and I'm not sure whether I do or not, but the next thing I want to go over is the chapter, the chapter 6 handout 2 I sent out today. Is there anyone that didn't get it? It's so new. I didn't.
Yeah, I have to go find it now. I think I downloaded it. I just did not. Oh, I got it.
Yeah. Okay. Yeah. So handout 2. This is. I just wanted to kind of go over a little bit of. This is just to kind of make the kind of what we just talked about a little more practical. Okay. So one thing about materiality. We're going to contrast the qualitative and the quantitative. I should say around quantitative and qualitative. Quantitative is the one that you usually think about. It's the dollars. Whereas qualitative are those things that are a little bit trickier. I made a mistake here. Go down here to the required. I stupidly put the answer in. This should be 50,000 and 50,000. These are understatements. You'll see why I put that in a second. And it's not just because I'm an idiot, okay? It's something completely different. Okay, so understatement. So make sure you change these down here. Do me this favor. I put those in wrong. Okay, so the expense account has a $50,000 misstatement in it. It's understated by 50,000. The overall materiality is 70,000. Now, one thing I'll tell you when you get a problem like this, if you're looking at the CPA exam, do not add anything into the problem. Somebody says, "Oh, I wonder if they have something else wrong." If it's not in the problem, it's not there. It didn't happen. So be careful on, well, what are the other accounts off by? Because assume that whatever is given to you is the only thing that is there. Okay, so 50,000. Get yellow. So 50,000 here in the expense account. Quantitatively, dollar-wise, is this materially misstated? We're saying that we'll allow for it to be off by as much as 70,000. So they find an expense account is off by $50,000. Quantitatively, dollar-wise, is this misstated? Anyone?
No,
Nope. No, it's not. Okay, qualitatively. Now, notice what would happen if we added 50,000 to this expense account. Okay. So this, maybe they should say minus is a better way to put it. Than negative. So this would be negative 2830. This is why I said let's just be quiet. There's no saving it now. Okay, so this is what these accounts should look like. And this would turn out to be a loss. 30,000. So for qualitative, is this misstatement material? Went from this to this.
I mean, could it be, I mean, if it was concealing a fraud, the $30,000, I mean, could that be questionable?
It could be, yeah, assume that it was a, this is. But one of the qualitative things that changes a loss to a gain. Or vice versa. So if it does change it, whether it's income to a loss or loss to an income, that's qualitatively means it could be material. In this case, I would say probably it is. It is material because this one shows that they're making money when actually they're losing money. So even though the $50,000 itself is obviously not material, it's less than the $50,000 error is less than the 70,000. It is more than likely, it would be a judgment call, but most likely this is good. It changes the gain, income in this case. Again, so this is one of those things that is not quantitative, it's qualitative. So qualitatively, it very well could be, I'm sure would be material in this case. So if it changes a trend or if it changes like from a gain to a loss or something like that, violates a contract, those are all things that even though dollar-wise, they're not material. Qualitatively, they are. So even though the 70,000, it doesn't reach the $70,000 level, it's still material. Question there? Okay, testing for assertions. First of all, we're going to go kind of through the flow of documents. So you start out kind of here. Source documents, invoices, receiving reports, shipping documents, all those things that those documents that we use to have transactions occur. Then we make journal entries for them. And this could be including special journals, things like the sales journal. They go to the ledger. I think this is making it more confusing. Let me start taking back out my numbers. Teaching this for 30 years and it's confusing me. So, all right. So journal entries, those are just for individual transactions. You write them down. General ledger takes all the transactions together, and it also has ending balances. I'm sorry, my little dog just ran into something upstairs. I have a little dog that is really fast, and she just crashes into everything. She, you know, she's like a Ferrari without a steering. Okay, the trial balance is only the account balances. And then from the trial balance, everything goes on to the financial statements. So from the source documents, they go to journal entries, general ledger, trial balance, and financial statements. Now, we're going to focus on the two, I don't think most important, but two of the types of testing that we do the most often, the most popular, are completeness and existence. Okay, so tracing the source documents to the trial balance would most likely be associated with which assertion? Okay, so we're going from here to here. So which are we most likely looking for? Are you looking to see that it is complete? That everything that we have listed is actually in there? Or are we looking for the existence? Is there something on the financials? Yep. Good. We're looking to see if it's complete. These source documents, this invoice, does this show up on the financial statements, you know, or trial balance in this case? Receiving report, does this show up in the trial balance? You know, all these things, you know, the shipping documents, does that show the sale and all that kind of stuff? Does that show up on it? So you're looking to see if this is complete. Okay, tracing the journal entries to the source documents. So you're going from here to here. So here's the journal entries. You go, let's take a look and see the source documents behind these journal entries. So you grab 30 journal entries and you go look for the source documents. Which one of these are you probably trying to get at?
Existence.
Yep. Yeah, because you're saying, okay, these journal entries, you know, if you're testing from here, from here back to here, you say, okay, are these real? You know, you get this journal entry down for equipment. Did you actually get the equipment? Let's see the invoice for the equipment. So you're going to see if, does this journal entry actually exist? You're going backwards. And so this would be existence. And you'll kind of notice that it sort of looks like this. You know, completeness testing kind of goes this way. And existence goes this other way. My arrows aren't straight there, but you get the idea. So completeness, you go from the source documents all the way up through to the financial statements, existence, financial statements, all the way back through to the source documents. So it's kind of going in the opposite direction. Okay. Let's see here. Which defining test would most likely be associated with the existence assertion?
B.
Yeah, good. You're gonna trace the financial statements to the shipping documents. You're gonna go backwards. So this is the existence one. You can go from the financial statement back to the shipping documents here. You know, you're trying to prove that they exist. Those sales exist or whatever it is you're looking at. Which defining would be associated with the completeness assertion?
B.
Yep. Yeah, here's the sales journal. And you want to make sure that everything on the sales journal shows up on the financial statements at one point, but you know, an intermediate step there, right? You see if it's on the trial balance. So these sales should show up on this trial balance. In other words, is this trial balance complete? You said it exactly right. Okay, so. Man, it's late. You save this. Okay, so here's what I'm going to do. I am going to give everyone here so here's what I'm going to do. I'm going to send out the multiple choice questions for chapter 6. I would too long, but I really want to get this. I want to get chapter 6 out of the way. The third week on it. As bad as it is for me, I know it's 10 times worse for you. So anyway, let's get this one out of the way. So I will send out the exam later on tonight, probably within a few minutes after, probably by 8:30, but certainly by tomorrow morning. It should be out, but probably sooner. And I'm also going to send out the multiple choice questions along with the solutions to them. Just because, so you can actually take a look at it. Now I'll give you guys full credit for the, I'll give you the extra 5 points, as if you did them all correctly, just because we didn't have time to do them. I wish we did, but anyway, so unless there's unless people want to really spend a lot more time on this, which I'm sure you don't. I'll send out the chapter 6 exam. It will be due on November 4th, a week from Friday. Okay, so I'm gonna send out the multiple choice one. You'll get credit for as if you guys all did well in the multiple choice one. And but I'll also send out those multiple choice questions so you can take a look at them, and you can kind of imagine some of those show up on the exam too, so you'll learn benefit on it. Any questions on that?
No questions.
Okay. All right, well, we'll be done with chapter 6. Finally. All right. Have a good evening, and I'll see you guys in a week's time.
Okay, thank you. Bye-bye.
Bye.